Ladies and gentlemen, Asian Guy here. It is the morning of December 29th, 2025. I want you to look at your screen. I want you to look at the red numbers that are flashing in front of your eyes. I know exactly what you're feeling right now. I know the knot in your stomach. I know the panic that is creeping into the back of your mind. You're looking at silver trading at $75. Just 48 hours ago, we were popping champagne at nearly $80. We were celebrating the all-time high of $79.57. We were talking about triple digits. We were talking about the unstoppable squeeze. And now, on a Monday morning, seemingly out of nowhere, the floor has dropped out. We are down $4, maybe $5, depending on the minute. The chart looks broken. The momentum seems dead. And the mainstream financial media, if they are even covering it, is probably telling you that the bubble has popped. They are telling you that the squeeze is over. They're telling you to sell before it goes back to $50. I am here to tell you to stop. Breathe. And listen to me very carefully. What you're witnessing right now is not a crash. It is not a correction. It is not a change in the fundamentals. Supply did not suddenly appear over the weekend. The mines did not suddenly discover 1 billion ounces of silver on Sunday night. The Chinese export ban did not get canceled. Nothing has changed in the real world. What you are witnessing is a trap. A specifically engineered, mathematically calculated high-frequency trap designed for one purpose: to steal your position 3 days before the world changes. We warned you about this. In the last update, I explicitly used the phrase Ghost Week. I told you that the week between Christmas and New Year's is the most dangerous week of the year for a retail trader. I told you that the adults are gone. The senior risk managers at the big banks, the heads of the trading desks, the institutional whales, they are all in Aspen. They are in the Hamptons. They are on their yachts. They are not sitting at their Bloomberg terminals in Manhattan. So who is running the market right now? Who is setting the price on this Monday morning? It is the junior traders. It is the B team. And more importantly, it is the algorithms. When the liquidity is this thin, when the volume is a fraction of what it usually is, the market becomes incredibly fragile. In a normal market, if someone wants to sell 1,000 contracts of silver, there are 10,000 buyers waiting to absorb it. The price barely moves. It is like throwing a rock into the ocean. But during Ghost Week, there are no buyers. The order book is empty. The bids are hollow. So when a bank decides to dump 1,000 contracts into this vacuum, the price doesn't just dip, it crashes. It is like throwing a rock into a bathtub. The splash is enormous. This drop to $75 is a liquidity illusion. It is an air pocket. The sellers pushed the button, and because there was nobody standing there to catch the knife, the price free fell until it hit a technical support level. It looks terrifying on a chart. It creates a massive red candle that screams sell to every technical analysis bot in the world. But you have to ask yourself the question, why? Why would anyone with a massive short position, why would anyone who knows about the shortage, who knows about the China ban starting on January 1st, choose to smash the price today? Why force it down to $75 right now? The answer is psychology. They are playing poker with your emotions. They know that retail investors are leveraged. They know that many of you chased the price at $78 or $79. They know you bought call options that expire this week. They know you're sitting on margin. And they know that if they can flash crash the price down to $75, they can trigger your stop loss orders. Think about how a stop loss works. You tell your broker, if the price drops to $76, sell my position to protect me. The banks can see those orders. They have a map of where your pain threshold is. So in this low volume environment, where it costs them almost nothing to move the price, they simply push it down until they hit that cluster of stop loss orders at $76. Once they hit it, your computer automatically sells. You panic sell. You dump your silver back into the market. And who is on the other side of that trade? Who is buying the silver that you just panic sold at $75? The same entities that smashed the price. They are shaking the tree to see what falls out. They are clearing the deck. They want to flush out the weak hands, the tourists, the gamblers, the people who don't understand the fundamentals, so that when the real move starts in January, the train is lighter. They don't want you riding with them to $100. They want your seat. This is a classic bear trap. It happens at the bottom of every correction, and it happens right before every major breakout. It is designed to make you feel stupid. It is designed to make you doubt your thesis. You look at the screen and you think, maybe I was wrong. Maybe there is no shortage. Maybe Elon Musk was lying. Maybe I should just take my loss and go home. If you have that thought, they win. You have to zoom out. You have to ignore the 1-minute candle and look at the yearly chart. We are up over 160% this year. A 5% pullback after a parabolic run is not just normal. It is healthy. It is necessary. Nothing goes up in a straight line forever. The market needs to breathe. It needs to test the conviction of the bulls. And let's look at the timing again. Today is December 29th. We are exactly 3 days away from the single biggest structural change in the silver market in our lifetimes. On January 1st, 2026, the China export licensing system goes live. That is the deadline. That is the moment the supply chain officially snaps. Do you really think that the smart money is selling 3 days before that event? Do you think JP Morgan with their 750 million ounce hoard is panicking because the price dropped $4? No, they are laughing. They are using this drop to accumulate even more. If they can buy back a few million ounces at $75 from a panicked retail trader, that is free money for them. They know that on January 2nd, when the full desks return, the price is going to re-rate higher. So this volatility is a gift. It is a second chance. For everyone who was crying last week saying, I missed the boat, it's too expensive at $79, I wish I had bought lower. Well, here's your wish. The market just gave you a time machine. It went back in time a week and gave you $75 again. And what are you doing? Are you buying or are you scared? That is the paradox of the investor psychology. You want to dip until you get one, and when you finally get the discount you asked for, it feels scary. It feels like catching a falling knife. But the fundamentals haven't changed. The shortage is still there. The vaults are still empty. The only thing that changed is the price on the screen, and that price is being manipulated by the lack of volume. I want you to imagine the trading floor right now. It is empty. There are tumbleweeds rolling through the offices in Wall Street. The guy pushing the buttons today is probably an intern or a junior algo manager. He has a mandate to keep volatility in check, or maybe to harvest some year-end tax losses. He doesn't care about the long-term thesis. He is just playing a video game with the numbers. Do not let a junior trader's video game wreck your financial future. Do not let a low-volume shakeout steal your position in the most asymmetric asset class on the planet. This $75 price is a mirage. It is a paper price. In a paper market that is rapidly losing relevance, the real market, the physical market, is not crashing. Go try to buy a monster box of Silver Eagles right now for $75 an ounce. Go call a dealer and see if they will sell to you at this crash price. They won't. They will charge you a premium. They will tell you, sorry, the spot price is down, but our physical price is up. Why? Because they know the truth. They know that the paper price is detaching from reality. And there is an even bigger signal that proves this $75 price is a lie. There's a piece of evidence that is so glaring, so undeniable, that it exposes the entire charade of the Western banking system. While New York is trading at $75, there's another market on the other side of the world that is telling a completely different story. A story that doesn't involve crashing. A story that involves panic buying. We need to look at what is happening in Shanghai, because while American investors are being tricked into selling, Chinese investors are doing the exact opposite. They are paying a price that would make your jaw drop. They are ignoring the COMEX spot price completely and setting their own reality. And the gap between these two worlds, the gap between the fake $75 on your screen and the real price in China, has just blown out to a historical extreme. If you think $75 is the real value of silver, you are about to be shocked. Because the arbitrage that usually keeps these prices together has snapped. The rubber band has broken. And what I am about to show you in the next section will prove, mathematically, that the $75 price is not just a dip, it is the sale of the century. The West is sleeping. The East is awake. And the spread between them is the fuse that is about to ignite the next explosion. Let's look at the numbers coming out of the Shanghai Futures Exchange, because they don't look like a crash. They look like a panic to secure metal at any cost. This is where the story gets interesting. This is where we see the ghost week trap for what it really is. While the cats are away, the mice are playing with the price in New York, but the tigers in Shanghai are eating, and the price they are paying is almost $15 higher than what you see on your screen. Think about that. $15? That is not a spread. That is a divorce. The two markets have divorced, and in a divorce, you have to decide who gets the custody of the assets. Right now, China is taking custody, and they are paying a premium to do it. So let's dry our tears about the $75 drop. Let's stop looking at the red candle, and let's look at the real price. The price that the world's largest consumer is willing to pay, because that price is the future. And the future is not $75. The future is much, much higher. And the gap, the spread, is the guarantee that this rally is not over. It is just reloading. Now, let me show you the math that proves the West is living in a fantasy land. Let me show you exactly what is happening on the Shanghai Futures Exchange right now. Because when you see the number 20,073 when, and you do the conversion, you will realize that $75 is the biggest lie of 2025. Let's do the conversion together. And this is where the story gets interesting. This is where we stop looking at the manipulated red candles on your screen and start looking at the mathematical proof that the Western market is broken. Because if you want to know the real value of silver, the value that the world's largest consumer and refiner places on it, you have to look at the Shanghai Futures Exchange. I have the live data in front of me. This is not a rumor. This is the closing price for the front-month silver contract in China right now, while New York is panicking at $75. The price in Shanghai is 20,073 yuan per kilogram. Now, unless you are a currency trader, that number probably means nothing to you. So let's do the conversion together. Let's translate it into the only language that Wall Street understands, US dollars per troy ounce. First, we take the price, 20,073 yuan. We divide it by the current exchange rate of roughly 7.0005 yuan to the dollar. That gives us approximately $2,851 per kilogram. Now we divide that by 32.15, the number of troy ounces in a kilogram. And what do we get? $89. I need you to let that sink in. $89. That is the price of silver in China right now. But if you look at your broker app, if you look at the COMEX spot price, it says $75. That is a spread of $14. That is roughly an 18% premium. In the world of global finance, an 18% spread on a fungible commodity is impossible. It is like seeing gold trade at $2,000 in London and $2,400 in New York. It shouldn't exist. Arbitrage traders, the sharks of the market, should be feasting on this. They should be buying every ounce of silver in New York for $75, putting it on a plane, and selling it in Shanghai for $89. They would make a risk-free $14 profit on every single ounce. They would close that gap in an hour. So why isn't it happening? Why is the spread sitting there wide open like a gaping wound? Because the arbitrage is dead. The mechanism that keeps the global price unified has been severed. And what severed it? The January 1st export licenses. The banks know that they can't ship metal into China and expect to get their money out easily. But more importantly, the Chinese sellers know they can't ship metal out. The flow has stopped. The global market has bifurcated. We now have two silver markets on planet Earth. Market A is the paper market in the West. It is dominated by derivatives, algos, and ghost week volatility. It is priced at $75 because there is no physical delivery pressure today. Market B is the physical market in the East. It is dominated by industrial users, solar panel factories, and strategic hoarders. It is priced at $89 because they actually need the metal. Which price do you think is the real one? Do you trust the paper contract that settles in cash, or do you trust the physical bar that goes into a factory? China is telling us the real price. The real price is $89. New York is lying to you. New York is telling you it's $75. The banks can cover their shorts before the inevitable snapback. This $14 spread is the smoking gun. It proves that the crash to $75 is artificial. If silver was really worth $75, Shanghai would be trading at $75. The fact that they are paying a massive premium means they are desperate. They are hoarding. They are front-running the ban. And think about the psychology of the Chinese buyer right now. They know that in 3 days, the export rules tighten. They know that the domestic supply is about to be locked inside the country. You might think, oh, if supply is locked inside, the domestic price should go down because there's a glut, right? Wrong. The price is going up in China because the local industry is terrified that the global supply chain is breaking. They're worried that even with the export ban, there won't be enough metal to feed their massive solar ambitions. They are bidding the price up to ensure they get every scrap of metal available. So, for the Western investor, this creates a once-in-a-lifetime opportunity. You are currently able to buy an asset for $75 that is trading for $89 in the world's largest market. You're buying dollars for 85 cents. This is not a falling knife. This is an arbitrage opportunity for you. You can't fly the metal to China yourself, but you can hold it. And eventually the Western price must rise to meet the Eastern price. It is physics. If the West stays at $75, the vaults will be drained dry by anyone with a license to move metal. The vacuum will force the price up. This gap, this 18% disparity, is the guarantee that the rally is not over. Bubbles don't have massive premiums in the physical market. Bubbles happen when the paper price is higher than the physical price. We have the opposite. We have an anti-bubble. The paper price is crashing while the physical demand is screaming. So when you see that red candle on your screen, do not despair. Look at it as a glitch in the matrix. The West is sleeping. The East is awake. And the East is voting with billions of yuan that silver is worth almost $90. In the next part, I'm going to explain exactly why the gap exists. We're going to look at the mechanics of the arbitrage break and why the big banks are powerless to close it. The Ghost Week trap is designed to make you sell your winning lottery ticket right before the numbers are drawn. Do not let them. Let's look at why the banks are trapped on the wrong side of this wall. And this brings us to the most critical question in the market right now. If there is a risk-free $14 profit sitting on the table, If you can buy for 75 and sell for 89, why isn't every bank in the world doing it? Why hasn't the gap closed? The answer is simple. The bridge is broken. In a normal market, this arbitrage is the gravity that holds the financial world together. It is the reason gold in London costs the same as gold in New York. If prices diverge, a bank pushes a button, moves the metal, and the prices snap back together. It is automatic. It is efficient. But what we are witnessing today is the death of arbitrage. The reason the banks cannot close this gap is because of what happens in exactly 72 hours. The January 1st export licenses. You see, for arbitrage to work, money and metal have to flow freely in both directions. But China has effectively turned its silver market into a Hotel California. You can check the metal in, but you can never check it out. Once a bar of silver crosses the border into Shanghai, it is now subject to the new restrictive export laws. It is trapped behind the red wall. If a Western bank ships 1 million ounces to Shanghai to capture that $89 price, they get paid in yuan. But then they have a problem. They have a pile of yuan inside China, and they can't easily convert it back to dollars and get it out because of capital controls, and they certainly can't get the silver back out if the trade goes wrong because they don't have an export license. So the risk premium has exploded. The banks are looking at that $14 spread and saying, it's not enough. They are terrified of having their capital trapped in the East right as the trade war heats up. This fear has paralyzed the arbitrage desks. And because the arbitrage desks are paralyzed, the prices are allowed to drift apart. The West has become an island. The COMEX in New York is now an isolated ecosystem of paper trading. It is a room full of speculators betting on a number, completely disconnected from the physical reality of the supply chain. On this island, the price is $75 because the speculators are scared. They are reacting to the ghost week, low volume. They are reacting to the technical charts. They are trading sentiment. But in the real world, on the mainland of industrial production, the price is $89 because the factories are hungry. Samsung, Tesla, and the Chinese solar giants don't care about the chart pattern. They care about conductivity. They care about keeping the assembly line moving. They are voting with their wallets that silver is worth $89. This creates a bifurcated market. We have a paper price, $75, and a physical price, $89. And history tells us exactly how this ends. It ends with the paper market collapsing into the physical market. It ends with a delivery squeeze. Think about it. If you are a global electronics manufacturer, let's say you're Apple, and you see silver trading at $89 in China and $75 in New York, where do you buy? You buy in New York, you drain the cheap market first. You stand for delivery on the COMEX. You take the bars out of the JP Morgan vault for $75, you ship them to your factories, or store them, before the price realizes its mistake. This is why the inventories are plummeting. The smart money is using this temporary discount to clean out the Western vaults. They are draining the island dry. And when the island is empty, when the COMEX has to issue a force majeure because they have no metal left to deliver, the price won't just go to $89, it will gap to $100 overnight. So this arbitrage break is not a sign of weakness, it is a sign of a broken system. It is a sign that the paper market has lost control of the physical asset. The fact that the spread is expanding, it was $10 last week, now it is $14, tells you that the pressure is building, not releasing. It is like a dam holding back a river. The water level, the physical demand, is rising higher and higher behind the wall. The wall, the paper price, is cracking. When it bursts, the flood will be biblical. And this brings us to the psychology of the moment. Why are they smashing the price now? Why drive it down to $75 during Ghost Week? Because they know the dam is about to break. And before it breaks, they want your shares. They want to trigger your fear. They want you to look at that $14 gap and think, oh, maybe the Chinese price will come down. No. The Chinese price is the anchor, the Western price is the kite, and the string is about to be pulled. In the next part, I'm going to explain the Ghost Week psychology in detail. I'm going to explain why this shakeout is perfectly timed to rob the retail investor right before the institutional money returns on January 2nd. They're playing a game of chicken with you, and if you blink, you lose your seat on the rocket. Do not blink. Let's look at who is actually buying this dip while you're panic selling. But we need to ask the deeper question. If the fundamentals are screaming shortage, and if the Shanghai price is screaming $89, why would anyone sell silver down to $75 today? Why smash the price 3 days before the biggest supply shock in history? The answer lies in the dark psychology of institutional trading. They aren't smashing the price because they want to sell. They are smashing the price because they want to buy, and they want to buy your silver. We have to talk about the Ghost Week psychology. You see, the trading week between Christmas and New Year's is a unique environment. The volume is thin. The order book is hollow. It costs very little capital to move the market $5 or $6 in either direction. If a big bank tried to crash the price during a normal week in February, they would run into a wall of buyers. It would cost them billions to force a drop like this. But today, the wall is gone. The buyers are on vacation. The only people left in the market are the algorithms and the nervous retail investors. So the banks use this vacuum to execute a maneuver called a liquidity flush. They know that thousands of retail traders bought in late at $78 or $79. They know you are sitting on small margins. And most importantly, they know exactly where your stop-loss orders are hiding. They can see the clusters of sell orders sitting at $76 and $75. So they push the button. They dump just enough paper contracts into the void to drive the price down to $75. They trigger your stop. Your broker automatically sells your position. You take the loss. And who buys those shares that you just vomited up? The same bank that pushed the button. They are stealing your position at a discount. They are effectively shaking the tree to see what falls out before the real harvest begins. They want to clear the deck of weak hands before January 2nd. Why January 2nd? Because January 2nd is the first trading day of the new year. It is the day when the massive institutional allocation funds, the pension funds, the endowments, the sovereign wealth funds, rebalance their portfolios for 2026. Billions of dollars of fresh capital enter the market on that day. And where is that capital going to go? It is going into the best performing asset class of 2025. It is going into the asset with the undeniable structural deficit. It is going into silver. The banks know this wall of money is coming in 4 days. They know that when those buy orders hit the tape on Thursday morning, the price is going to rip higher. So they are front-running their own clients. They are using Ghost Week to load up their own proprietary books at $75 so they can sell it to the pension funds at $85 next week. They are arbitraging time. They are buying in the past, Ghost Week, to sell in the future, January. This is why the $75 price tag is a lie. It is a manufactured price point designed to create fear. They want you to look at the chart and think, oh no, the trend is broken. The bubble popped. They want you to doubt the Shanghai data. They want you to feel stupid for holding. Because if you feel stupid, you sell. And if you sell, they get your ticket to the rocket launch. Think about the entity on the other side of this trade. Do you really think that a sophisticated trader who sees silver trading at $89 in China is panic selling at $75 in New York because he thinks the price is going to $60? Of course not. The only people selling right now are the people who are being forced to sell, the stopped-out retail traders and the margin-called gamblers. The buyers are the sharks. The buyers are the ones who know that the China export ban isn't a theory anymore. It is a law that goes into effect in 72 hours. This is the ultimate test of your conviction. It is easy to hold silver when it is going up every day. It is easy to be a silver bug when the green candles are stacking up. But can you hold when the price drops $5 for no reason? Can you hold when the chart looks ugly? Can you hold when the bank tries to reach into your pocket and take your wealth? This drop is the final exam before graduation. If you sell now, you fail. You become a statistic. You become one of the millions of people who almost got rich but got shaken out at the bottom. But if you hold, if you recognize this trap for what it is, you graduate to the next level. You graduate to the level of the smart money that buys when there is blood in the streets, even if the blood is fake. So, when you see $75, do not feel fear. Feel contempt. Feel contempt for a rigged system that has to resort to cheap tricks during a holiday week to keep the price down. And feel confidence in the fact that their tricks are failing. The premium in Shanghai proves they are failing. The fact that they have to smash it now proves they are terrified of what happens next week. In the next part, I'm going to focus entirely on that specific catalyst. We have talked about the Ghost Week trap. Now we need to talk about the January 1st trigger. Because in 3 days, the rules of the game change legally. The trapdoor closes, and the banks know it. Let's look at exactly what happens when the clock strikes midnight on New Year's Eve. The countdown has begun, and you are holding the winning hand. And now we are staring at the clock. We are staring at a countdown that ends in exactly 72 hours. This is not a vague prediction about sometime next year. This is a hard, legal deadline that is written in stone by the government of the second largest economy on Earth, January 1st, 2026. That is the date that changes the silver market from a global free market to a strategic resource war. And today is December 29th. We are standing on the edge of the cliff. The market is trading at $75, completely ignoring the fact that in 3 days the supply chain gets severed. We have to talk about the hoarding reality. You see, the $14 premium in Shanghai, that massive gap between $89 and $75, isn't just a number, it is a behavior. Why are Chinese industrial giants paying $89 right now? Why aren't they waiting? because they know what happens on Thursday. They know that starting January 1st, the new export licensing system goes live, and they know that this system is designed to keep silver inside China. So every solar panel manufacturer in Jiangsu, every battery maker in Shenzhen, every electronics giant in Shanghai is doing the exact same thing right now. They are panic buying. They are sweeping the warehouses clean before the rules change. They are securing their inventory for the first quarter of 2026 because they are terrified that after January 1st, the flow of metal will be strangled by bureaucracy and state quotas. That $89 price is the sound of a door slamming shut. It is the price of insurance. They are paying a premium today to guarantee they survive tomorrow. And meanwhile, what is the West doing? The West is sleeping. The West is trading Ghost Week. The West is selling silver down to $75 because a few algorithms triggered a stop loss. The disconnect is absolutely staggering. While China is treating silver like oxygen, New York is treating it like a discarded lottery ticket. But here's the catch. The West wakes up on January 2nd. On Thursday morning, the hangover wears off. The traders return to their desks in London and New York. The industrial procurement managers at Tesla and Apple look at their inventory sheets. And they are going to pick up the phone to call their suppliers in Asia. And for the first time in history, they are going to hear a busy signal. They are going to realize that the cheap metal they used to import to smash the price is gone. The China tap has been turned off. This is the moment the squeeze becomes real. A squeeze doesn't happen when the price goes up. A squeeze happens when you can't get the metal. When those Western buyers realize they are cut off, they will turn to the only market left open to them, the COMEX. They will see silver trading at $75 and they will laugh. They will scream, buy! They will try to buy everything at 75, everything at 80, everything at 85. They will try to close the gap with Shanghai in a single afternoon. This is why I tell you that $75 is a trap. The banks know this demand shock is coming. They know that on January 2nd, the buy orders will flood in. So they smash the price today to get your silver cheap, so they can sell it to Tesla expensive on Thursday. It is the ultimate front-running operation. They are arbitraging the ignorance of the retail investor against the desperation of the industrial user. And you have to understand the mechanics of this export ban. It isn't just a tax, it is a license. To export silver, you now need a government-approved license. Do you know how long it takes to get a license in a communist bureaucracy during a resource war? It takes weeks, maybe months, maybe never. For the month of January, exports from China will effectively be zero supply, into a market that is already running a 200 million ounce deficit. So do the math. If you take 20% of the world's refining capacity offline overnight, what happens to the price? Does it stay at $75? No, it teleports. It snaps back like a rubber band that has been stretched to its breaking point. The drop we are seeing today is the pullback on the slingshot. The further they pull it down, to 75, to 74, the more violent the launch will be when they let go on January 2nd. This is why the next 72 hours are the most critical hours of your investing life. You are holding an asset that is being artificially depressed 3 days before a massive supply shock. It is like holding a winning betting slip on a horse race that has already been run, but the bookie hasn't updated the scoreboard yet. The race is over. China won. They secured the medal. Now we are just waiting for the scoreboard in New York to catch up. And when it catches up, it won't be a slow climb. It will be a gap. You will wake up and the price will be $82, then $85, then $90. You won't get a chance to buy the dip because the dip was today. The dip was the Ghost Week illusion. So ignore the red candle. Look at the calendar. December 29th, 3 days left. 3 days until the rules change. 3 days until the arbitrage breaks. 3 days until the West realizes it has been cornered. In the final part of this update, I'm going to give you the specific forecast for January 2nd and 3rd. I'm going to tell you exactly what to expect when the slingshot is released. We are going to see volatility that makes today look like a calm breeze. We are going to see the price try to close that $14 gap in record time. Get ready. The Ghost Week is ending. The real year is about to begin, and it begins with a bang. So, what happens when the clock strikes zero? What happens on Thursday morning, January 2nd, when the world wakes up? We are going to witness the slingshot effect. Think about what the banks did today. By smashing the price down to $75 on low volume, they have pulled the rubber band back as far as it can go. They have created a deep discount right before a massive demand shock. On Thursday morning, two things happen simultaneously. First, the China export ban legally goes into effect. The flow of metal stops. Second, the institutional desks in London and New York return from holiday. The senior traders sit down, turn on their screens, and see two numbers. Shanghai at $89. New York at $75. They will panic. They will realize that the inventory island of the West is about to be drained dry by the arbitrage vacuum, and they will hit the buy button with everything they have. This is why I am forecasting a violent gap up. I do not believe we will slowly crawl back to $80. I believe we will gap there. We could see silver open on Thursday morning at $82, then $85, then run straight for $90 to try and close the spread with China. The market will try to correct a 2-week mistake in 2 hours, but be warned, it will not be a straight line. When the volume returns, the volatility will be nauseating. We might see $10 swings in a single day. The banks will fight to keep control. They will try to smash it one last time. They will try to run the stops in both directions. If you try to trade this, if you try to be cute and sell at 85, to buy back at 80, you will get slaughtered. You will get chopped up by the algorithms. Your only strategy is to do nothing. You are already holding the winning ticket. You bought the metal, you survived the ghost week trap. Now, you just have to sit on your hands and watch the show. Do not sell into the hole today, and do not sell into the spike on Thursday. Because even at $90, silver is just getting started. We are moving toward a world where the price is set by physical scarcity, not paper games. The era of cheap silver ends on New Year's Eve. The era of just-in-time delivery ends on New Year's Eve. The era of the real price begins on January 2nd. This $75 drop was the final test. It was the last chance for the banks to steal your wealth before the repricing. If you were listening to this, you passed the test. The trap was set for the weak. The reward is waiting for the strong. This is John A.G. from Currency Archive. Remember to like, subscribe, and share.